Investing 101, what you need to know to grow your money. This is part two of my series of Money Matters. Part one, we explored the importance of financial literacy, especially at this age. Today, we're talking about investing, what it is, why it matters, and how to choose the right approach for your goals. And I brought back Betty, Hildebrand, and Sharon Ruddy from SB Group Private Wealth Management. They are financial advisors with over 20 years of experience helping people navigate investing and wealth strategies based in Oakville, Ontario. In part one, we talked a little bit about understanding and having financial literacy. And I know it could be very overwhelming, but at least to start the initial conversation and getting some of the knowledge. And today's episode, we're going to talk more in depth about the actual investment strategies people can think about and see if they would benefit from. When it comes to investing, because I know a lot of people feel very overwhelmed. I know I, first of all, started late in investing. And number two, I was very overwhelmed. Like, what's an ETF versus index fund and all to a TFSA with a RER or RESP or RRSP. Anyways, so how do you explain investing in simple terms for someone who's starting out?
Yeah, I mean, I think investing in simple terms, a lot of people can relate to real estate. So investing is getting your money to work for you and grow over time. So when people think about buying a home, most people think over time, my home's going to appreciate in value. So I might buy it today for $1 million and hopefully by the time I sell it, it's worth 2 million. So investing is just getting your money to work for you over time and to grow in a productive manner.
That's a really good example to show, especially in the Canadian housing
Yeah.
market.
Right.
But why is investing important, especially for women over 40?
Well, I think what Sharon is saying is we need to be able to keep up with inflation. We need to be able to grow our money so that we have the choice to be able to do the things that we want with it. So investing is important because we need our, simply put, is we need our money to grow over time and be able to use it to purchase the things that we need, to be able to do the things that we enjoy. So that would be why we need to invest. I think one of the things that people always say is like what's saving and what's investing, because you're saying you're investing every month. And there's some people that save every month. So saving is really just more short-term goals. So if you're saving for a house and you want to buy it in 6 months, you're saving. You're not going to be taking risk with it, because with risk comes the reward of investing. But investing is more being able to invest in the market and be able to ride out the highs and the lows and get growth over time.
And talking about the highs and the lows right now at the time of recording, there's a lot of uncertainty in the global markets due to war and oil prices and the US dollar. And I've invested in Canada and in the US. And so I log in. Now I don't log in every day. Last year I was logging in every day and I was like, woohoo! But I feel like also with the AI bubble and just the tech stocks taking a step back, there's a lot of fear and uncertainty right now when it comes to investing and what we should do with our money. So can you talk a little bit about investing in times where there's a lot of uncertainty in the global markets?
I think one of the key pieces to remember about investing, and listen, we're all humans and human behavior comes into play when we talk about markets and volatility and uncertainty. But one of the most important parts to remember when investing is it's not about timing the market, it's about time in the market. Nobody's got a crystal ball. If we did, we'd be, in a very different place somewhere, I'm sure on a private island somewhere, sipping on a, whatever your drink of choice is. There are strategies you can use to weather storms over the longer term. And when you're working with an advisor, what they're going to do is help to understand what type of risks you can take on. There's a term we use, which is called capacity for risk. So it means not just your tolerance. People say, oh, when markets are great, everybody has a high risk tolerance. I can take the ups and downs. But then when we hit times of uncertainty and volatility, like right now, the closer you are to needing that money, the harder it is to withstand the ups and downs. Understanding what the risk factors are, working with professionals that can help you make sense of your capacity to take on risk will allow you to weather storms and certainly not be looking every day at what the portfolio is doing.
Because I think the closer you are to your magic number or your retirement age, that was one of the things my advisor talked to me about is when are you going to need access? Is that a fair question? Like, when are you going to need access to this money? My current age too, because she was calculating how long I'd be putting money into the market. on average. And those were big determinants because right now, even in like the 1930s, which was the Great Depression, markets always rebound. I think the stat is over the last 100 years, the S&P 500, the average return rate is 7 to 10%. Knowing that, I'm trusting that even in the Great Depression, there was still time to capitalize. And I think we talked a little bit about it might be a good time to buy and invest because markets are low.
And I think this is where just to take a step back is just, when you start to invest is understanding your investment style, understanding the purpose of what you're investing for, because that really determines what your underlying investments are. And though in markets where everything's soaring and there's certain stock that are flying through the roof and everybody wants to get on board, usually too late, the slow and steady of an egg in every basket and being diversified in times like this, if you have an understanding of what you're actually holding, understanding the risk of, certain life events and what's going on in the world, how that affects your portfolio. And then to your point is your time frame. So if your time frame is 6 months from now, like we said, that's not a lot of time to be able to recover from. And if you're only holding one investment that really pertains to a certain place that is very affected, like oil and gas, you mentioned it, there's a lot more risk that happens there. So really understanding why you're investing the way that you are and what you're trying to achieve and what your timeline is.
You brought up a little bit about diversification and why diversification in your investment strategy matters. When we talk about main types of investments, what are the ones that people should know about? Can we talk a little bit about stocks, bonds, ETFs, mutual funds, real estate? What are the basic investments that people should know about?
You named most of them. I mean, a lot of people, when they start investing, they tend to start in mutual funds. And the reason for that is because if you buy one stock, and we know the prices of some of these popular stocks nowadays, let's say you have $1,000 to invest, holding 3 shares of something is not a very effective strategy. But a mutual fund allows people to pool money. So a lot of people start out that way. As they create more wealth, more options become available to them. And so we work, for example, with clients where we deal with private assets. So that's a category of assets that are not correlated to public markets. You have to be an accredited investor to have access to them. So the more time you've been investing and the larger wealth you create, the more options there are available to you. Things like ETFs are great for young people starting out as well, because inefficient markets like Canada and the US, they can be a low cost way to just ride the markets. And with young people having lots of time on their side, you can just buy the market, ride it through all the ups and downs. And over time, to your point earlier, you're going to do well. There are things like GICs and bonds, which sometimes clients who are really risk averse, they will start to use those if they can't take on any risk. The problem with that is you're barely beating inflation. So you're, back to the conversation about growing your wealth. That's not necessarily going to be the most effective way to do it.
Can you tell me the difference between an ETF and a mutual fund?
Mutual fund, and there's many, many different kinds of mutual funds. It can be geography based, it can be purpose based. We can't buy one share of Apple stock, but if we get 5 friends, we could buy Apple stock and we could buy some Nvidia, maybe we could buy some banks. So really it's just a pool of investments and you're sharing in the growth and the losses within that. And that comes with a fee, where ETFs tend to mimic just a market like an index. So it'll just take the US market or the Canadian market and mimic that, which makes it it's low cost because there's not a lot of moving parts. There's not a lot of buying and selling commissions, things within that. So the ETF will be lower cost, but it is just following the market. So we're talking right now that the US market did wonderfully the last couple of years, and there's some volatility. So that would attribute back to the performance of the fund. It's very specific. So they have changed a lot in the last couple of years. So there is active ETFs, which are more like a mutual fund. They are a little more purpose based. So the lines are getting skewed in terms of what they look like, where they used to be a lot more cut and dry. But a lot of ETFs have very mutual fund like qualities, and then the cost is starting to reflect that as well.
Traditionally, mutual funds were considered more active management, and ETFs were considered more passive. And now you're starting to see these hybrids in the middle, which was what Betty was just speaking to, which is ETFs that do have an active component. So you can kind of think of them on a bit of a spectrum, right? Mutual funds being more actively managed, ETFs more passive, and then you've got lots of things in the middle. And stocks are wonderful. We still have clients who invest in stocks. They serve a big purpose in client portfolios, but there are ways to invest in those stocks through different types of programs where you're getting a more optimized portfolio of individual equities.
The crystal ball, Nvidia stock, I should have bought that. Right?
My favorite saying I heard, I think it was a fund manager
Yes.
many years ago saying, he said, I have my crystal ball, but I got it from IKEA and I just haven't put it together yet.
Yeah.
So yeah, we only had the crystal ball. We'd all be,
Yeah.
yeah.
Well, I think the adage is if everybody's talking about it, it's probably too late to invest in it, right?
Exactly. And then there's no certainty on how much it's going to grow and how long it's going to grow for, too. But the key is not timing the market, but time in the market and definitely diversifying your portfolio so you're not heavily weighted. So, for example, if tech stocks take a bit of a hit this year, your portfolio still has other assets in there. What's the difference between active investing and passive investing?
There's layers to that, but I think we alluded to it in the simplest terms is, passive would be, buying a set of stocks or buying an ETF and just letting it ride. Where within mutual funds, or we now have discretionary funds as well, where portfolio managers are making active decisions minute to minute or day to day within their funds. So depending on the mandate of the fund, they could say, we bought this stock, this is where we thought the projection of where we thought growth was going. And if that happens by 10 o'clock in the morning, they've gotten their growth and they can sell that off. Or right now we see future and international versus Canadian and US seems a little bit overvalued. They can head in that direction. So that would be a lot more active management versus here's my 10 stocks or my 10 mutual funds, and we're just going to let them ride.
How does time horizon and goals affect investment choices?
Well, I mean, the longer you have,
Mhm.
typically, the more risk you can take on. So that's the most simplistic answer is when the longer the time horizon, the more you're able to withstand the ups and downs. And the more volatility or the more risk you can endure, the likelihood you're going to get better outcomes over the long run. So time works on your side. The shorter the time frame, typically the less risk we have. Because if you're going to need the funds in 2 years, we don't want to be withstanding, very large fluctuations in the market.
And are there different strategies or considerations for women who are starting to invest later on in life?
I don't know if there's different strategies. So I think one of the things that we will say about investing and women, especially, but men as well, is really understanding what your personalized approach is, what your risk tolerance is, what your capacity is. Because, any advisor will say, oh, my client came in and their neighbor invested in this. I want this. They said to 20%. Well, your neighbor might have a different dollar amount that they are able to invest. They may have a different time horizon, whereas it has to be personalized to you. How you invest has to make sense for your goals, for your capacity, for your tolerance, for your family. There's risk is, multi-layered in terms of what risk you can take on. So if it's your last dollar, how you invest that is very different if it's your last $1 million, right? So it's very personalized, I would say.
Okay. And so if somebody's listening to today's episode and they've started the initial conversation because they've listened to part one, whether it be with their partner or taking a self audit, now they know their numbers. What do they do next? What's step number two?
Well, I think something that we haven't talked about is how you're investing your money and which accounts. So you alluded to RESPs, RSPs, TFSAs, and then non-registered accounts. So, and this gets into the financial planning. If you're a high income earner, you'll want a tax shelter and have tax deduction. So you would use an RSP. If you have extra savings over and above that, you would next likely go to a TFSA. It's after tax income, but you're also sheltering that growth. And then you want to be able to have non-registered as well, because we're talking right now about starting investing and getting to retirement, but you have to always take into consideration that you're going to get to retirement one day and you have to be able to take that money out taxed optimally as well. Because if you're just taking out of RSPs, you're being taxed on that money. So it's not just step one would be you're having the conversation. Step two is understand how you're investing in different accounts and how that's beneficial to you.
We call that asset location. What Benny just described is asset location, which can be equally as important as what you're choosing to invest in, is where we are holding those for all the reasons that Betty just discussed.
With your RRSPs, you're just deferring your taxes,
That's
right?
right.
It's a tax shelter,
Exactly.
right? And so
Yeah.
that's where you have to look at your income and decide, okay,
Mhm.
what makes sense financially? If I have a limited amount of money to invest, what makes more sense? Should I be putting my money in my TFSA or my RRSP? And that's why working with financial advisors such as yourself who would sit down and go over your portfolio will help you, give you that information for you to make an informed decision. How often should someone review or adjust their investment portfolio?
Yeah, I mean, important question. I think the answers are going to be varied. So, minimally, once a year, you want to be making sure you're taking stock of this, minimally. But it's driven by things like life events or what we call in our industry material changes, change in a career, change in partnership status, a death, a birth, all of those life events are when you need to be revisiting your portfolio. But I
Mhm.
think one of the things, and you just alluded to it, which is so important, is establishing the financial plan because the portfolio and the financial plan are two different things. The portfolio is embedded in the financial plan and they are, not mutually exclusive of one another. But the financial plan, establishing that is how you're going to know how frequently you should be adjusting the investment portfolio because the financial plan is going to be driving all those things that we've been talking about, and particularly the conversation we just had around your decumulation strategy. How are you eventually going to access all the money you've been saving? Having that financial plan in place and working with individuals like us, where we use a very sophisticated state of the art software that's AI driven that helps you derive all of those permutations and calculations that you need to know. That's going to be really important. And then when you have that financial plan, you are not going to be beholden to your investment portfolio changes all of the time, right? Because you're going to know that they're driven by the plan. They make sense, they're purpose driven, and your advisor should be at least engaging with you on an annual basis to make sure that there haven't been any changes. So it was a long winded answer, but it's an important answer.
It's an honest and real conversation to have even with your children because now we are not just providing until they're 18, it's past that.
We're on the payroll a lot longer these days.
Payroll is very it's good. Their salaries are high. If I could just circle back to what Sharon said, because you said a lot of important things in that conversation, is the importance of the financial plan is us knowing what our clients' intentions are as well, right? So how you plan for education savings depends on how you want to contribute to your
Mm.
children's savings, how you want to retire. We have a lot of clients that are like, I want my last day on earth. I want every penny spent. And some people are, I really want to leave a legacy. Well, those are two very different financial plans and two very different values, and your investments and everything else accordingly has to flow into that. So just to, really, if we leave you with one piece, is that like really have that deep relationship with your advisors so you can have all these
Mhm.
conversations with them.
Really important. We are definitely on the payroll much longer. Yeah, it is, but, that's the reality now with just the cost of living and honest conversations to have with our
Mhm.
children because I don't want them in any sort of financial debt. I want them to maintain their wealth and grow their wealth. I will say I did a episode talking about TFSA, and I
Mhm.
actually don't like the name TFSA because it's tax-free savings account, and I feel like it should be rebranded to tax-free investment account because I think so
Yeah,
many people think,
that makes sense. Yeah.
that episode, a friend reached out saying, "Oh my God, I've had a TFSA and the money's just been sitting there for the last 7 years."
Realize that our kids though, and I think, it's not something you asked in a question, but it's just a thought because we've talked about it before. And I think, our generation, when we grew up, there was a physicality with money, right? We had, especially when we were younger, your parents would give you physical money, whether those were coins or a dollar bill if you were lucky enough, right? And so you had a relationship with money that had a physicality to it. Our, children and these generations, it's all digitized, right? So it's on their phones. It's a tap. The parents' credit cards are attached to their phones. So it's more important than ever for them to start to develop a relationship with money, right? And understand what that exchange is and the different paths to building wealth and how debt management is essential and credit management and building credit ratings and all of those things. And so, it's a bit beyond the conversation today, but it's so important for that generation to start to really understand their wealth and the financial literacy piece because it's not taught in schools, right? And
Yeah.
so it has to be part of the conversation that families are having. And we hope
Yeah.
that in our relationships with our clients, we start to generate those conversations for them and we assist with those conversations because they're so critical.
I've seen the news reports and consumer debt it's like at an all-time high.
Right.
And I think because their numbers on a screen, exactly what you're
Right.
saying.
Yeah.
Whereas
Yeah.
in our time, I used to work
Right.
at Winners, and when somebody wanted to buy something and they couldn't afford it, they put it on layaway. So they
That's
would
right.
put
I
Yeah.
remember that. That's right. Layaway.
you're
Yes.
right. Remember that? I
Yes,
worked the
that's
layaway
right.
counter. The item
That's
was $50 every week. They'd come
that's
in and
right.
they would pay $10 every
That's
week. And
right.
then on the fifth week,
Yes.
they got the item. That's not the case now. Access to credit
Mhm.
and things like Afterpay and, you could just buy now and do it in payments afterwards,
Yes.
but not understanding the implications of all of that. How to use credit, like credit cards are not a bad thing. Yeah, I think they're good in establishing your credit, but one thing I always say is you could only buy what you can pay. You don't want credit card debt. To me is like, that's the one thing I did learn in school. Credit card debt has the
Right.
highest interest rate. This isn't really about investing, but credit and understanding how credit works
For sure.
is an important investment tool in
It
your
is.
life because credit is so critical when you're even trying to get a cell phone plan. They do a credit check.
Well, and it's not critical to investing per se, but it is very critical to a financial plan. I think Sharon
Yes.
said before is that's part of your net worth statement and getting children to understand like here's what you have, here's what you owe. If that's a negative, like you said it, you're already starting out backwards,
Mhm.
right?
Mhm.
So getting children to understand their financial plan, how as simple as it would be, like net worth statement is critically important.
And understanding that your financial picture is different than everybody else's. So when
Mhm.
kids have the comparison, especially in our culture, well, no, well, so and so
Sure.
got this and so got
Yeah.
that. Well, that may
Right.
work in their family. That doesn't work
That's
in our
right.
family. How can women take control over their investments and feel confident in their decisions when it comes to investing?
Well, I think all the things that we talked about today, but like it's about being informed. It's about start being educated. It's about starting the conversation. And I think what's important is starting the conversation with a professional, absolutely, if you're ready to invest. But I think just as women, we have to start having the conversation about money. It has to stop being so taboo. We talk about all of this all the time. Everybody thinks something magical happens in the house next door, that they've got, this magic secret to money, and nobody really understands what everybody's going through. And I think the more that we can start having conversations about money as women, the more that people would seek advice and seek education.
For sure.
Like,
I think even beyond, or say before, is sometimes in terms of taking that step. Obviously, we would encourage you to work with a professional, like we said,
Mhm.
but even just taking stock of your money mindset as women, because there are stories that we have around money that have been embedded and imprinted that sometimes we're not even aware of, and they were passed down generationally. And I think we talked about that, at the beginning of episode one, but just taking a moment to just say, what are my money stories that I may subconsciously have that I'm not even aware of?
Mm.
And how are they informing some of the decisions I've made to this point? And are there different stories that could serve me better? And as I move into taking greater control over my wealth, what are some of those new mindsets around money that would help me as I make different decisions?
does your group do with seminars? How do you get your client intake?
Yes, to all of the above.
Yeah.
Most of our seminars, we haven't done a lot of online seminars. We
Yeah.
do a lot of in-person seminars, but I think it's something that we have thought about doing to
Yeah, we're
engage.
definitely
Yeah,
open to it if there was an appetite for it. Well, we will do. So part of our business is to give back because not everybody's our client, right? And I think that was one of the things we wanted to say too is find an advisor that fits right for you as well in terms of how many assets you have and what they do for their clients.
yeah,
Where can listeners learn more or get help when it comes to investing by connecting with you?
yeah. Our website, elevateyourwealth.ca, is a great place to start because you'll get to find out a little bit about how we operate. You can also reach out to us through there. We also have an Instagram handle, which is SB Group
Private
Private
wealth.
Wealth. But our website is sort of that place if people want to find out a little bit about us and our philosophy. That's a great starting point. We have clients across the country because we are licensed in multiple provinces. So that's certainly something that we have a pretty robust discovery process with new clients to make sure all the things we talked about, that there is a good fit. And if for some reason it isn't a client that is our target client, we will always help them to find the home of best fit. So we're always open to having those conversations and helping people find the right advisor and the right platform for them and what they're looking for.
Okay, great. So if you're listening right now and you are based in Canada, please reach out. I will put all of Sharon and Betty's information in the show notes so you can reach out to them and start the process of understanding investing, how to invest, and how to grow your investment portfolio. What is one thing you want a listener to take away from today's episode in regards to investing?
There's a lot we want them to take away.
Yeah.
I think for myself is just to push back this stigma of like, is this a silly question? Just being able to find the confidence to find a little more information, find it in a way that resonates with you. You know, the good thing is we have started talking about a lot of information available to us. There's a lot of people on Instagram that are sharing information. So just, take that first step to step out and try to educate yourself and find what will work for you.
I would say, I know it sounds cliche, knowledge is power,
Yeah.
and power allows you, and knowledge allows you to have choice, and choice is freedom.
Choice is freedom. Correct. So much goes into different life choices as we age, but thinking about the future and how investing in money plays a part in that is a key pillar. So that brings us to the end of today's episode on investing. My hope is that these conversations have helped you take some mystery out of investing and reminded you that you don't need to know everything to get started. You just need the right information and the confidence to ask questions. Investing isn't about timing the market or getting it perfect. It's about making thoughtful choices that align with your goals, your values, and the life that you're building, especially at this stage of life. I'd like to thank Betty and Sharon from SBIG Private Wealth Management. If you want to connect with them to get a more tailored plan, please check out the show notes for their contact info. If today's episode was helpful, share it with a friend who's ready to learn more about investing. If you enjoyed today's episode, make sure you subscribe and continue the conversation over on Instagram or TikTok at Her Energy Unlocked Podcast. I cannot wait to hear from you. Until next time, remember, your energy is yours to reclaim, your story is yours to rewrite, and your next chapter is waiting. And I will see you in the next episode. Bye for now.